Hi, my name's Sharpe and I'm the founder and CEO of QuantConnect. Today we're going to be doing a slightly different video where we're going to be looking at some of the recent movements in the market and then trying to test some of those ideas that we've picked from the current trends and themes that we're seeing and testing them and building a strategy on them in QuantConnect. So the idea is for us to explore a hypothesis and to test that hypothesis in the platform and then see if we can see how it goes and implement it in a fairly raw way where you can see how we go about the process of debugging and fixing those challenges and building that strategy from scratch. So there's probably going to be a lot of bugs, and I'm going to try and be very transparent about how we're going about evaluating and building the strategy. And yeah. I'm glad to have you with us. Let's get started. The topic that I was interested in recently was this theory called risk parity. Since about the 90s, there's been a strategy where you do an allocation to stocks and bonds, and depending on the breakdown of that, you can apparently mitigate your risk. A lot of the funds which were based on risk parity strategies suffered in the very recent sell-off in March because the theory is that when the stocks fall, bonds normally rise. So the challenge is, though, that in March, we actually saw stocks and bonds fall simultaneously. The strategy, people claim that it broke down and that it's kind of like this underpinning core thesis to all of the robo-advisors that we see today, and a lot of the very large funds like AQR and Bridgewater, they're all based on this risk parity idea. Let's test that theory, and specifically I came across this fascinating thread on Twitter by Corey Hofstein. He is suggesting that rather than having a strategy which is just a fixed 60-40 between bonds and stocks, that you should actually do rebalancing in small amounts and frequently. Imagine that you take your $100,000, you put $60,000 into stocks, $40,000 into bonds, and then a year goes past and your stocks have increased in value and the bonds are about the same. So you actually need to readjust your portfolio to get it back to an equilibrium, which is 60-40 in stocks and bonds. A lot of the questions people ask about this sort of strategy is, when do I rebalance? How frequently do I rebalance? Do I rebalance every day? And how many fees do I get from rebalancing so frequently? So these are all things that we can backtest. Let's take this as our thesis that doing tranched rebalances, as in you don't need to rebalance your entire portfolio, but rebalance, say, 1/12 of your portfolio, and do it every month. Do it frequently in relatively small amounts to get the best performance. So this is based on research published by AQR. So we can see here that depending on the rebalance mechanism, you can get very substantially different results. So using a platform like QuantConnect, we can go in and we can just set up an easy experimentation framework where we can test all these different ideas. Let's start there. Go to the algorithm lab. The key insight from a strategy like this actually doesn't change. You have a 60% weighting on stocks and a 40% weighting on bonds. So there's actually no need to do any sort of intraday insight creation or anything like that. We're just going to keep it very simple and make a universe, which is the S&P 500 via the SPY ETF and the bond ETF, and then have a fixed insight that goes for the whole period because there's no actual change to the strategy. So firstly, we want to try and choose a period which covers as long as possible. So ideally we could get the 2000 crash, the 2007 crash, and then the current crash that we're in now, so that we could see how the strategy performs. So this is also probably best tested on a larger capital base, so we can increase that to 1 million. So here we can create our universe. And portfolio construction, and we can pull all of that from the documentation. So big fan of not needing to remember this stuff. So you can just paste in a lot of this from the docs. So this is actually pretty close to what we want. So here we're going to be using daily resolution because we're going to be backtesting very long periods very quickly. And then we want a index ETF and a bond ETF. So what should we use as our bond ETF? So we want something with a very long track record, and we can go to like the ETF DB and we can see a listing of a whole bunch of bond ETFs. Here we've got the biggest one by volume here is AGG. So let's open a few of the high volume ones and see which one might suit us. And the general rule of risk parity is to get something which is it's more about government and treasury bonds, not corporate bonds. So we can skip the corporate ones here. Shy. Okay, and then there's no hard and fast rule here, or if there is, I'm not familiar with it, but we might pick an ETF which allows us to test a long period. So this one's AGG is September 2003, 2007 for Vanguard, and Shy is 2002. So maybe we can use Shy to kick us off. Okay. So we've made a universe. Let's just get a basic equal weighting algorithm running, and then we can come back and we can test, start building our hypothesis after that. So let's go to execution. We just need an immediate execution model. And then we can go to portfolio construction. And to kick this off, let's just use some of the stock portfolio construction models here. So this is just the equal weighting portfolio construction, and we can just throw that in. So then alpha here, and we can just take the equal weighting, the constant alpha model. Okay, and then the last one here we don't actually need to set, but just for completeness, let's set the null risk execution. Okay, so this is just the absolute basic framework algorithm. So we're going to build this framework algorithm from these stock components and just have a SPY and Shy. And because of the way that we've coded this, we're using an equal weighting portfolio construction model. So this is going to be 50-50. So this is just to get us running, to get the basic algorithm running. And actually this won't work because Shy, as we saw, has an inception date of 2002. So let's start the backtest from 2003. SPY has been around forever. So we can start from 2003 and run a backtest from there. Cool. All right, great. So we're off the ground. We've got this thing placing trades. We can see here there's an equal allocation between SPY and Shy. And then you can see down here we're doing a lot of insights, and you can see from the fees we're doing a lot of trading. The default rebalancing models, the default in the framework is this daily rebalance. So we can start looking at ways to firstly get our 60-40 weighting, and then also to reduce the rebalancing so that we're not doing daily rebalance and costing $9,000 in fees for such a simple strategy. Let's start with getting the 60-40, and then we can do the rebalancing fix after that. Probably a nice way to do this in the framework is to use a model which ships with Lean. It's the insight weighted portfolio construction model, and that will just allocate capital according to the weights that are assigned on the insights. with a framework model, there's these insights that are generated, which are kind of predictions, and it's supposed to set the direction of the portfolio. And so for this, because we have the same allocation forever, we can actually just produce an insight forever that's exactly the same, and we'll say we want 60% on stocks and 40% on bonds. So to do that, it's probably easiest to create our own alpha model. So we can come to the documentation here, and we can copy just the basic scaffolding. So we can say here risk balance alpha, and we need to do some work and return insights. Okay, and then here we're not going to have a whole bunch of security changes here, so we can just pass and use this as our new alpha. Let's get rid of this. We're going to set our alpha as this risk balance. We have here SPY and shy, and so this is just a simple array, and this is 0 and 1. So let's pass that in, because we could have our assets configurable. So this would be SPY, and this would be shy, and then we need a constructor here to catch that. And so we can pass in 2 symbols that we want to create a insight for. So let's save those 2. Okay. And then probably because this is going to be a very simple insight, we can actually just create insights here. So we can say self.insights equals something, and then we'll have insights here that we can return. Maybe we'll return them here. So now we just need to create some insights which are weighted. So we can go to the docs here, creating insights. We can see the creating an insight class here. So here's an example of creating a weighted insight. So insight.price, take this here, paste it in. And so we want to create an insight of 60% for the risk asset and 40% for the safety asset. Okay. Risk and safe. And then we're running this backtest since 2003, let's just say 20 years. So we're going to say days equals 20 times 365. So the idea here is we're just going to create an insight which lasts for 20 years and is going to be 60% SPY and 40% safe. And then we'll do all of the work in our rebalancing code after that. So we've created these insights. Let's return them here. Yep. Let's just do a quick test of that. Okay, cool. The code's built and running. We haven't finished coding, so obviously we expect it to not be quite trading the perfect balance yet. The next step is we're emitting these insights with 60/40, but we've set here a equal weighting portfolio construction model which isn't built to respect them. So we have somewhere in Lean we have a insight weighted portfolio construction. So the best way to find that would probably just be to go to Lean, and we've got a bunch of these modules underneath the algorithm framework here. So under portfolio and then insight weighted portfolio construction model, the Python implementation here, and you can see we've coded up the implementation to do a portfolio construction model weighted by the insights themselves. So we set that here and test that and see how we go. Okay, cool. Once the backtest is done, we should probably do just a really quick sanity check. So we haven't even started on doing the rebalancing frequency yet, but we'll get to that. So the first thing we might want to sanity check is the simple 60-40. If we do some quick napkin math, we can take, here we've got 9,000 shares filled at $63 for SPY. 9,550 times $63. And so we're seeing $600,000 allocated in our first trade to SPY. So that lines up with what we're expecting, a 60-40 weighting. So of the $1 million in the portfolio when we started, the very first trade is setting it to be 600,000. So it's a good start. And then the next point, before we get on to tranching and looking how to optimize this, let's look at getting the rebalancing under our control. So there was a recent discussion in the community about this, and we went into a relatively new feature here. So we can actually now, using the portfolio construction models, we can disable the automatic rebalancing and make it use completely manual rebalancing. So the first step to that is disabling this rebalance on insight changes. So that means before, typically by default, it would rebalance when an insight expires or when you added a new insight to the portfolio. By using this, you're saying don't do any rebalancing on those new insights. And then secondly, rebalance on security changes, which is when a new security was added to the universe, trigger a rebalance. So both of those things are disabled. And then finally, the third thing, which was discussed here too, is using a rebalancing function. A rebalancing function is a function which will return the time at which you should do a rebalance. So this allows you to build some sort of rules into, for example, monitoring for portfolio deviation or monitoring for some sort of trigger that you want to use to trigger that portfolio rebalance. So that's just a function, and you can pass it in to the portfolio construction model, and then when you return a time, it will rebalance on that time. Otherwise, if you return none, it will continue asking you until you give it a time to rebalance. We actually have an example here, again on GitHub. So you can see here, it's simply just passing in a function. So we want to define the function here in our code. We can see this rebalancing example function here. This one's a much more complicated one, but the keys that we need to take away is that it has a time here and you can return none. So let's just copy something simple here, constantly return none. Sometimes I like to just run back tests to sanity check things. In this case, we've changed our code to prevent all rebalancing. And so a nice sanity check there would be to run a backtest and see nothing happen. And that way we can just know that we are in complete control of when the algorithm is doing rebalancing. And so you can see here, even though we've got hundreds of insights, we're not doing any trading whatsoever. That's a great start. We're now in control of the portfolio and we're generating insights. So one thing that we might want to check here, this is emitting hundreds of insights. There's 2 every single day, and the insights are for 20 years. So really we don't need to emit thousands and thousands of these, and it's just a huge waste of energy. So let's update that. So we're going to say we're going to detect if we've already emitted the 20-year insights. If we've already emitted them, then just return nothing. Otherwise, set our flag and then emit the 20-year insights once. The idea would be that we would get rid of all of this noise that we're emitting for years and years, which is presumably going to slow things down. So let's sanity check that. And then run a backtest. Cool. So we see here we've got exactly one prediction for each one, and we've got one trade here at the very beginning of our backtest, and so that's exactly what we wanted to do. Now, when should we rebalance? This is the key. This is what everybody's talking about for their 60-40 models. Let's try the basic. What most people do is some sort of time rebalance of their entire portfolio. And if you recall, the thesis was that to do a time rebalance of 1/12 of the portfolio, every month rebalance a fraction, and so over a year period you would be eventually fully rebalanced. We'll get to that partial rebalance. At the moment, these insight weighted, all the portfolio construction models that are included rebalance the entire portfolio. So we can start by simply getting this to go every month. So if we get this going every month, then we can work on the rebalancing a fraction of the portfolio after that. So a very simple way to detect month changes would be to literally detect the month change. We can also, on all of the portfolio construction models, they take date and time schedule rules, which is automatically handled by QuantConnect, that when the month changes, we can trigger a new rebalance. Just for simplicity and so that you can fully see how this is under your control, we can say month and do this here. We can do something like this, just if So this is skipping any scheduling rules here. We're just creating this, initializing this flag at -1. And then it's always a good idea to handle the starting case, the null case. We're here detecting the -1 and returning the time. And then here we're saying that if the month changes, that the current time changes, then set it and return the time. Otherwise, do nothing. So we would expect this once a month to do rebalancing of the entire portfolio. So let's see how it goes. Okay, so we have it trading again, and our rebalancing function is triggering trading. And the bug, though, that we're seeing is that it's trading every single day. So we're seeing the same $8,000 in fees that we saw before. So let's dig into this and see where I got it wrong. Look at this. So if the month is equal to -1, just return time and don't do anything else. So we need to set this here. So this will handle our default case, and then the next time around we'll come through and set this properly. Okay. Hopefully we see what we'd expect now is to see the fees drop from 8,000 down to something more manageable. And then we can verify that with the trades and check each trade. So already backtest is finished. We've seen the fees drop from $8,000 to $500, so we're probably doing fewer trading. And then we can come down here, and once it's done, cool. Let's look at the trades. Okay, on the 1st of January, we've done some position sizing, and then you see here the 1st of February, March, April, perfect. So you can see here the large trade occurred at the very beginning. So this is opening our initial portfolio. And then the subsequent trades are relatively small because it's just a slight rebalancing to maintain the 60-40 split. So that's good. That's a good foundation to build from. We have relatively low fees. We have monthly rebalancing. We have the 60-40 split. So the last piece here is the Traunch Rebalancing. So instead of rebalancing the entire portfolio every single month, the thesis by Corey was that the best portfolios are if you rebalance them, a fraction of them, every single month. The expense of rebalancing the entire portfolio is probably too high, and so you might be able to save costs by only rebalancing a fraction. So it's kind of like this hybrid of dollar cost averaging, where you buy the dips on the way down, and risk parity. So let's see if we can try and get that technology into this algorithm. So there's nothing built like that ready to go in QuantConnect for you. So the only thing we can do is take the existing portfolio construction model and try and improve on it. Here we're using an insight-weighted portfolio construction model. Let's use that as our foundation and create something off that to achieve the 10 or 12% rebalancing each month versus rebalancing the entire portfolio each month. So this is the Python code for the insight-weighting portfolio construction model. And we want to try and use this as our foundation and build off that. So we can start just by copying this code. So this is all open source. This is inside the Lean framework folder here under the portfolio construction models. And so we can come into our algorithm, create a new file, and we're going to have our own portfolio construction file here. So I always like to delete a lot of the noise. There's too many comments for me. So we can trim this down and okay, cool. So let's just start by renaming this. I'm going to call it our Traunch portfolio construction model. And we'll put this here. And we need to import this. So we've got Traunch. From our code, import everything. Sorry. Say everything. So this is our portfolio file. So from portfolio file, import star. So this is going to be all this. And then before, this is the insight weighting portfolio construction model. So before it was extending the equal weighting. So unlike the equal weighting, the insight weighted just uses a slightly different weighting, but rebalances the entire portfolio anyway. So what we're doing here is quite different. We're going to only rebalance a fraction of the portfolio every month. So we can extend from this and try and tweak it to what we need to do. So the core of how these work, firstly, it gets the list of active insights. So the portfolio construction models don't need to worry about generating those signals. They just take them from the alpha model. And then it goes back to the here, and it determines the percent of the portfolio we should allocate to that asset. And in this particular case, it's an array where we group the insights and then a double weighting that we assign to those insights. So we are determining the target percent here, and so in our example, we're going to have a portfolio that was, say, it started out at 60%, and then over time it's drifted to 80% on stocks because the stocks have gone up in value. So we need to find the difference there. So we need to find 80 minus 60, and the 20% that we need to move, we need to do that slowly. So before we were doing all of that 20% rebalancing in a single trench. So now we want to try and take this 20% and do it over a slower period. To do that, we can probably start by calculating the difference here and then get a factor to apply to discount the full move, because we don't want to move the full 20% in one trade. So we can here, we can even say here, for example, this is going to constantly say that we want 60-40 on those two insights. And we could actually just edit the results here. So we could do something on the previous calculations to slow that migration so that it doesn't occur in a single trade but occurs in many trades. It's a bit of an approximation, but I think just multiplying it by a factor to slow it down would be good enough for our testing. So for example, this can be our benchmark, and perhaps we want to pick a specific period which will show some pretty significant rebalancing. So here, if we look at, say, the period from September to October 15th, or September 1st, maybe, yeah, March to April 2009, this period has got a very significant rally, and so it'll trigger a very significant rebalance. So we can probably see that in the trades from 2009. If we increase this, just so that we can get a sanity check on our code that is working as expected. Right, you can see that here. So March to April, we see large trades of stocks, both directions, in a single month. We dramatically increase our position and then dramatically decrease it the very next month. So this is a nice example case of the rebalancing causing churn in the portfolio, going one way then the other and triggering lots of fees when it's only been a very short time. And that's something that this style of trench rebalancing might be suitable to improve. Let's have a look, keep this in mind. So we'll come back to this one here. We see 480 and then 300 the very next month, minus 300 the very next month. And let's yeah, actually, so after doing some thinking about how this code would look after we try to hack it into where we need it to be, I think it might actually be simpler and cleaner to leave the insight weighting portfolio model and to do this with a slightly different approach. Instead of us doing adjusting the portfolio targets each month, the portfolio target is relatively static. It's 60-40, and the goal is to use 100% of the portfolio. The difference is, though, that by doing it in trenches, we're effectively executing that vision slower. So instead of just executing 100% of it every single time immediately when the portfolio comes through, we're going to try taking the targeted rebalance and then reducing that by a factor and executing that reduction. So the hope is that by doing this, by the time the next month rolls around, if there's a big event like 2009 where there was a major rebalance one way than the other way, because we had that slow rebalance, we won't have made a shift in the wrong direction too quickly. With that slight change in tack, let's go back and revert a couple of these changes. We can delete the portfolio, our custom portfolio, and then revert this back to the insight weighting portfolio construction model. That's good. And then now we're back to the point where we have an insight weighted portfolio construction model, and we have this immediate execution model. So let's do the same thing we were doing here and go take a look at the immediate execution code. So that's all open source here. For this one, actually, it is open source, but it's done in C# just for speed. So you can actually find that. There you go, the algorithm. And so we can just copy this guy, and create a new execution model in our algorithm. Okay, hopefully this is a better track and will keep us from needing to write some really ugly code. Okay. We're figuring this out on the fly though, so let's see. Cool. So we'll just call this the slow execution model. Put that there. Okay. So the execution models are delivered targets. These targets are what the portfolio construction model would like you to execute, and then it's up to the execution model to know and do the actual filling of the targets that were given to it. So you can do whatever sort of logic you need. We have helper collections here like this one, so a portfolio target collection, which is just a helper to hold the collection of those targets from the portfolio construction model. So when targets come in here, it can add them to this collection, and then it can do things like tell you if you're trading in the right order. For example, you might want to sell some shares before you buy others so that you have enough buying power to place the trades, and that's all handled for you in these helper methods like portfolio target collection. Here again, this is another helper method, order sizing. You can get the unordered quantity. So if you pass in the algorithm with its portfolio and the target that you're trying to execute, it will go and do the math for you to figure out, based on the orders which are open, how much of the target have we got left to fill. We can actually cheat a little bit here. We know that this is being called once a month, and so we can sort of use that for now to get this bootstrapped. And see here we're saying we just get the unordered quantity and then we place a market order directly for that stock. What we might want to do instead is simply, let's say, divide this quantity by 10 and then fill it slowly over time. So one thing that I'm not sure about yet is this is a daily resolution algorithm. This might be filled over 10 days, or it might be filled over 10 method calls. And I'm not sure whether or not this method gets called every day or whether it gets called every rebalance. So we'll figure that out quickly and then we'll come back and change the code. So at the moment we'll just divide it by 10 so that it fills slowly and so that we can see the change in the orders that are being created. And then we can debug what it's doing exactly. To get a benchmark case, because we're making a change in the execution model, let's actually set set the immediate execution model to get our benchmark so we know what we're looking at. And then we can compare our new execution model to that benchmark. Okay, great. So we have our benchmark here. We can see a couple of things. Say here, February, the first trade that came in was 126. We sold the bonds and that was filled immediately. So let's tweak it to our execution model. And just a hunch, we'll probably see it fill over the next 10 days. So we will see a slow fill in the first trade as well, the large one, and we might see a spike in the fees. Wow. So previous fees rebalancing once a month were about 500. Up to 8,000 here. And obviously placing a whole bunch of small trades is going to cost you a lot of money, so we need to make sure that we're rebalancing every month and not just causing an increase in trading. So we need to adjust how that execution model is filling. You can see the dates here, 2013, August 9th, 10th, 13th, 14th, 15th. So the hypothesis that the code was running every single day and updating the execution model is correct. We need to make sure that we do this execution every month and not just every single day. Otherwise, we're right back to our daily rebalancing. The core of the Traunch rebalancing was that we would take 1/12 of the portfolio and rebalance that. So with the targets that come in, these equate to 100% of the portfolio. And so by dividing it by 10 or 12 here, we're trying to adjust it to be 1/12 of the portfolio is rebalanced every month. So we can change this slightly. So when we get the new set of targets at the beginning of the month, we then allow it to execute a new tranche of the rebalancing. So we'll do the same simple month logic here. So if the month is -1, we want to trigger. And then make sure we save the month. Okay. And return. And then otherwise, if this is a normal rebalancing, we'll do the same thing. If month equal to So I've just made place orders up. We'll create that method in a minute, but it's just doing the same thing, that we want to do these executions relatively slowly every month. But start, we'll rebalance a fraction of the portfolio. So let's come to that now. So we'll come through, this is the execution code, which is called every day, and every time the month changes, we'll recalculate the trench to rebalance and allow some market orders to go through and rebalance that trench. Alright, this looks good. So every month now is going to be getting the orders, the targets that it needs to fill by the margin impact. So what that means is it'll sell the ones which need to be reduced first, so that we can free up the buying power. So then we'll get the quantity we need to trade to hit the targeted rebalance, and then divide that at the moment by 12 to convert it into a sort of monthly rebalancing, and then send off the market order for that symbol. This one here is just tidy up. It's just saying to clear out the targets collection if we've fully fulfilled that target. There is little differences here which will make it slightly inaccurate, and I'm not sure if it matters. So for example, every month this quantity is going to be exponentially decaying. There will always be a little fraction that isn't being rebalanced. So in an ideal world, you would literally do 1/12 of the quantity, and we wouldn't need this. But this way, it's appreciating that the market's probably not going to move in the same direction forever, and that you're going to have changes in the way that this quantity is and what this quantity is requesting. We'll come back to that. Maybe we can make that more accurate slightly later. So let's try this. And execute. There is one catch with what we've written to. Yeah, first we need to pass in the algorithm here. And then here, if you notice, even on the first month, this is only going to be placing 1/12 of the trades that it needs to do, which isn't right. We need to, on the first month, we need to make the full position size so that we can compare apples to apples. So let's make this a factor here that we pass in, and we can use that factor in the division. So here this is divide by 1 for the first month, and then for the subsequent months we'll do 1 divided by 12. Let's see how this goes. So I'm just going to rename this one here benchmark. This benchmark was our rebalancing every single month, the entire portfolio. So we're trying to beat this one. All right, let's see how we go. Wow. It's smoother than I thought. Okay, good. So we have adjusted the factor that we're using to rebalance. The first month we'll rebalance the entire portfolio. After that, we'll only do 1/12 of the portfolio for every 1/12 of the requested rebalance every time. So here, this factor is being passed in to scale the orders down. And so if we have a look here, wow, 6 trades. So we've seen relatively low fees and a Sharpe ratio of 1.0. And here, if we go back to the beginning, we can see, as expected, we did a massive rebalance on the 1st of January. Yeah, the trades don't look as expected. So let's dig into this, see if we can figure out why. This is our benchmark every month. And here was the target rebalance. It was supposed to sell shy and buy SPY. And the quantities here are relatively small. And then our current backtester looks like it's not respecting that at all. It's actually increasing the leverage, which is very strange. So let's dig into that. presumably this is something about our execution model and not filling all of its trades. Well, for starters, we can see that from the trades that it's processing on February 1st, February 3rd, February 4th. So it's not respecting the month rebalancing. That's number one. That should be an easy one to spot. Let's find that. Here we go. If the month isn't equal to the algorithm time month, we're placing the trades and we're not actually resetting our month clock. So now we reset the month clock, we should absolutely be rebalancing once a month. We should be filling the trades once a month, I mean. So let's replace that one. And then we need to figure out why the portfolio targets that are being passed in are so huge. Wait for the trades to finish. It looks like it might be compounding, it might be some sort of effect of the portfolio targets growing each month. Let's experiment with this here. We'll eventually go look at this code, but for now let's experiment by only adding the targets when the month changes. We don't really care about the interim targets, or what I'm guessing is happening is there's 22 trading days in a month, and the target rebalance here for the first one was 126. So 126 times 22, it's on that order of magnitude anyway. It looks like it's compounding the rebalance target. So let's just only add the targets to our collection when we want to actually do the rebalance. So yeah, I always like to look up the classes and see how they work. So if you can pretty much find any class of lean just by going to lean and looking the search this repository. We've got the test there, and then we can look here and we can find the actual class. There you go, portfolio target collection. And so the key thing is here, don't get scared off because it's C#. It's just another piece of code, and then you can see here we're adding the portfolio targets. We're setting the targets for that symbol, so they shouldn't be accruing. Adding a range, we set all the targets for that symbol. And then clearing fulfilled here, this is the code we're calling at the end. Cool. So look at the actual holdings of that security and then see whether to remove that target from the collection. And a lot of other boilerplate code for the dictionary. Okay. So when we do this add range here, we're overwriting any previous targets. This should be fairly safe. We can actually leave that here as it was before. And then we can see here that if the month changes, we're going to do our place order routine. Maybe something here about getting the unordered quantity, because this is what gives us the quantity, and then we come down here to see the quantity traded. So maybe let's see if we can understand how get unordered quantity works. So looking up the get unordered quantity, the very last one here is the order sizing, and the method we're calling is get unordered quantity. So we can find that one here. So it's relatively simple. It's just the target minus the holdings and rounding it down to the lot size. So it shouldn't be skewing there. Ah, there we go. Just a simple error. So here we're doing divide by factor. So we just need to do multiply by the factor because otherwise we're going to be scaling up our quantity. So let's see how that goes. What we'd expect is 1/12 of this to be the first order in February, so roughly 13 shares, 12 or 13 shares. Let's see where that is. So our fees are right about where they were before. So we're seeing slight reduction in fees, and here on the 1st of February, oh, sorry, jump to the first one. Okay, so here on the 1st of February 2003, we see about 10 shares filled and then 5 SPY. So if we jump to our benchmark, we can confirm, yeah, it's roughly 1/12 and then roughly 1/12. So it looks like we are filling and rebalancing slower than we were before, as we had hoped. So the thesis here was really that we would, for example, in the period of 2009, where you have very volatile dip and then a very volatile rise, that we could see a more efficient rebalance. So if we can jump to 2009, about halfway. Here, from yeah, it looks like we've reduced the positions that we're changing. We can compare that to this is from 2009 from our benchmark. Okay, so from here to here, this is our test case. See, on March 2nd, 2009, we increased our position of SPY by 500 and then immediately decreased that to 300. So then over this period, doing the same thing, we can see that we increased it by 200 and then reduced it by 123. So it is slowing. Oh, sorry, it's the other way around. So oh no, there you go. So see here, it's SPY. So we increased it by 200, and then we went on to increase it again by 146. So because it had the time to do the rebalancing, it didn't immediately flip the position over that 1 month. It was continuing to increase our holdings versus simply just flipping. So hopefully that's actually reducing the churn and maintaining a little bit of momentum in those rebalancings. And let's see how that does in terms of performance. So we can see the overall trading is, compared to the benchmark, about the same, roughly about the same amount of trading. Our drawdown on the benchmark was 35%. Our drawdown was 32% with our new rebalancing. And just in case it wasn't clear before, the benchmark here I'm using as a monthly rebalance of everything versus a monthly Traunch rebalance. And so we can see here the Sharpe ratio is 0.615 versus 0.595. So there is a slight improvement in the Sharpe ratio by doing this Traunch rebalancing. And just for fun, let's see if we, instead of doing instead of doing 1/12, let's just slow it down, say 1/3, and see how it goes. So overall, it's about the same fees, same trading, drawdown slightly increased, Sharpe ratios decreased, and let's just confirm it's operating as we expect. We can see here, instead of the 10 that it was placing before, now we've jumped up to shuffling 40 and 21, which is roughly 1/3 of the benchmark, which is doing 130 on this first trade. So you can see that here, 130 versus 63, and on our new one with our factors, we can see it's effectively rebalancing about 1/3 of the portfolio each month. So that's good. So that's a good framework. Now we can use this to experiment. And so the overall thesis about whether Traunch rebalancing is more effective than a simple full portfolio rebalancing every month seems to hold up. We saw a reduction in drawdown and a increase in the Sharpe ratio. So that was kind of the point, to test this thesis and see how it went. And I'm glad that we saw a positive result, and now we have this scaffolding where we can test portfolio rebalancing and Traunch rebalancing in a relatively easy way just by changing a factor on the algorithm. So I think that concludes this video. Thank you for watching, and we're going to try and continue this series of investigating algorithms about the market and about things we're seeing in the markets every week. So tune in if you've got ideas of current events that you would like to be covered. Please let me know in the comments, and yeah, look forward to chatting with you next week. Cheers.